Now, Jovenpreet Singh will further evaluate and discuss Domain Holding Australia Limited's annual report of year 2018 in compliance with Australian Accounting Standard Board's Intangible Assets Guidelines from document AASB 138. In its annual reports, Domain Holding Australia clearly stated the acceptance of Australian Accounting Standards Regulation inclusive of AASB 138 in making of financial statements, which makes sure that each account meets its required definition standards and eligibility criteria. Under the notes to financial statement, the accounting policy has been registered for an asset recognition which complies with the notion of identifying it only when probable economic benefit will flow, and it shall be reliably measured from AASB 138 document. After identifying whether certain acquisitions can be recognized as an asset through definition and recognition criteria, now we are going to look how to put money value on an asset for the accounts. Accounting policy has been stated under notes to the financial statement of group structure, which resembles with what is written in AASB 138. From the date of acquisition, the acquired business contributed approximately $133.9 million Australian dollar of revenue and $22.1 million Australian dollar to net profit before tax from continuing operations of the group. On 29 October 2017, Domain Holding Australia Limited acquired the legacy business of Domain from various subsidiaries of Fairfax Media Limited for consideration of 1,279 million Australian dollar and goodwill worth of 1,036 million dollar, includes the required workforce and future growth opportunities. Moreover, an addition has been made in year 2018 via acquisition through business combination of brands, mastheads, and trade names of worth 263 million Australian dollars, software of worth 13 million Australian dollars, and software which is accounted as a capital work in progress of worth 686 million Australian dollars. Regardless the nature of an asset, if the asset does have a useful life and active market, then it can be depreciated or amortized. Goodwill does have different cases, as it neither does have a definite life and an active market to calculate the fair value, so it needs to be impaired. As stated in accounting policies for impairment of asset in Domain Holding Australia's annual report, an impairment loss is recognized for the amount by which the asset's carrying amount exceeds the recoverable amount. Assets that suffer an impairment are reviewed for possible reversal of impairment at the end of each reporting period. In 2018, impairments to Mastercard worth of 11.9 million Australian dollar, goodwill worth of 4.7 million dollars, equity accounted investment of 12.3 million dollars, and other assets of 0.7 million Australian dollars recognized because of rebranding of the Weekly Review magazine by Domain Australia, decision to exit certain business during the period because of losses, deterioration in the value of investment due to decline in the market in which they operate. These changes led to reassessment of the carrying value of the relevant asset to ensure the carrying value does not exceed the asset recoverable amount. Where the recoverable amount was determined to be less than the carrying value, an impairment charge has been recognized in the period.